This is a Momentum Media production.
The SMSF Advisor Show, your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone, and welcome to the SMSF Advisor Show. I'm Miranda Brownlee and I'm joined by Aaron Dunn. Hi Aaron.
Hi Miranda, how are you?
I'm good. A bit sad that this will be my final podcast with you on the SMSF Advisor Show.
Yes, we have had now 62 odd episodes for our SMSF Advisor Show, and you've been an integral part of this show. And you are going on to bigger and better things, of course, in the Accounting Times publication as part of Momentum Media. But the show will go on, of course, and we'll certainly miss your contribution. And it's been great to be able to work with you, obviously, through this period. And even getting, of course, catching up face-to-face yesterday for Brooke, Pepper and Roger's event that we had in Sydney. And we had our virtual event and raised $20,000+ for her treatment in Germany. And many of you will have seen the promotions and stuff that we did about that. And to everyone that was a part of it, a huge thank you, because it does make a huge difference on her and her family. So it was great to be able to share that and obviously have you a part of that, facilitating the Q&A panel.
Yeah, it was great to be able to raise that money for Brooke. And obviously you put a lot of effort into making that event happen, Aaron. So we definitely should thank you as well. And also thank you for being such a wonderful co-host over all these many episodes. You've really brought a lot of technical expertise and knowledge. And so thank you for that.
Excellent. All right. Well, let's get into what's making news. So, Miranda, let's have a bit of a discussion about what has been on SMSF Advisors news front.
Yeah, so we've had a few different things happening, but we have seen that Senate inquiry report into the franking credits bill, which contained those two main measures for reforming franking credits. So with one of those measures, which was to do with frank distributions where it's funded by capital raisings, the committee has recommended that those measures be revised a bit further to make sure that they're better targeted. And that's obviously been welcomed by groups like the SMSF Association, who are a bit concerned about what kind of impact that was going to have on retirees.
Yeah, so I think what we can take from this is the way in which it's going to work probably has more overreach than what was expected, and therefore quite clearly there needs to be somewhat of a reset. There's obviously still a lot of people frustrated by the approach that Labor's taking to this, in particular that, they did announce that there'd be no changes that would impact superannuation in this term of government. Yet here we are, and we do have an example of that being the case here. So it is a positive, I guess, that we take out from this, that there is, from the review, further amendments to be made. And I guess we'll just need to see from there what passage this takes to becoming law.
So we've also seen some comments from the minister that he does intend to release the quality of advice review very soon. And we've also seen a report from the Australian Law Reform Commission sort of explaining that where super sits in terms of the legislative framework and whether there should be further changes there as well. So quite a bit happening on the advice front again.
Yeah, so there is a sense of waiting to see how the government's looking to respond to the QAR. And there's been some concern around, to what extent and how the government is going to tackle, many of the issues that were addressed in that. Of course, from an accounting body's point of view, they've been quite vocal in the fact that there is some hope that we'll see accountants play a role in what that advice framework might look like in the future. But it's quite complex to try and unpack this, because when you read the Australian Law Reform Commission background paper, which was only published within the last month or so around this superannuation and legislative framework for financial services, they actually referred to SMSFs as misfits. So from that point of view, what they're acknowledging is that, they are so driven by tax, but they sit within a Corporations Act framework. So, where do they actually genuinely fit? And we think about something like investment strategies, and there's references to those sorts of things. Is it actually a financial services product? And therefore, does it fit under the Corporations Act? So So that it needs a huge body of work to try and get this bit resolved. But there's an immediacy around a lot of these issues because, of course, as the article that you're referencing, Miranda, spoke about, Tony Negline from Chartered Accountants ANZ really spoke to the fact that we've got this upcoming introduction of a $3 million threshold and an additional tax. And this is going to mean we have people that are going to need to obtain advice about their current superannuation benefits and whether they need commutations or they might be taking lump sums out, whole range of areas that would need advice on. And we know that most of those funds have the trusted advisor as the accountant in that space, and many of them don't fit into the current licensing regime. And we don't want to end up in the same position that we did back in 2016-17, where the accounting profession was really hamstrung by a lot of the actions that could be taken to comply with the introduction of the transfer balance cap. And so I guess they're just raising this issue now and saying we need some resolution on this going forward. And I know there'll be others that'll say, well, there's a licensing framework that allows for people to get that advice. The reality is there'll be a range of SMSF people who won't, and they have that relationship already. But there are a number of flags that would need to be addressed as part of this process. And the Law Reform Commission's trying to navigate through those, but whether we get any resolution on that in time before we see these measures likely to come into play from 1 July 2025, and therefore the action that needs to be taken, well, we're just going to have to wait and see.
Yes. And on a positive note, we have seen advisor numbers actually go up for the first time in many years. So after it declining for 3 years, they have finally increased. Yeah,
so I guess, again, is it too early to really determine if it's a recovery or it's a bit of an anomaly? But I guess that generally can be seen as a bit of a positive for the industry there. A lot of that, again, is going to be based upon what we see in terms of the government's approach to try to get a new path or trying to navigate through what the advice process might look like, and therefore how much appeal that has for new entrants to ultimately come into the market.
And just one other final thing, we've also seen another significant increase in the number of disqualified trustees for the March quarter, which means that over the financial year so far, compared with the same period in the previous financial year, we've seen a 130% increase in trustee disqualifications, which the ATO had kind of warned would be happening as it sort of increased its compliance action.
Yeah, and I guess it just demonstrates the behavioural shift that the ATO has taken based upon the behaviours of trustees ultimately. So from that point of view, I really believe that the ATO is their three strikes process or their traffic light process to saying, we're going to ensure that we have a robust superannuation system. And if you don't, hold up your end of the bargain, then we will utilise the full force of the law that we have available to us. And that does naturally include the ability to provide directions and then disqualification of various parties. And it's that activity, I guess, where we've gone through a period of hand-holding through COVID and many of the issues that we had, but coming out the other side, the ATO says you have obligations. It is a privilege to be a trustee of a self-managed super fund. And if you don't uphold your end of the bargain, expect us to come at you. And, this is just proof that they are holding up their end of the bargain because others aren't holding up theirs.
All right. We're now going to hear from Tim Miller, who's going to be taking us through some of the end-of-year tax planning that SMSF should be thinking about. Today, we're joined by Tim Miller, SMSF Technical and Education Manager at Smarter SMSF. Hi, Tim. How are you?
I'm well, Miranda. How are you going?
Good, thank you. So today, Tim's going to be sharing with us a range of tips, traps and strategies to look out for and employ with your clients in the lead up to 30 June. So just to start off, can you give us a quick overview of some of the contribution strategies that professionals are going to be looking at with their clients in the lead up to 30 June?
Yeah, certainly. Look, I guess it's an interesting sort of 30 June for a number of reasons, but primarily because of the indexation of the general transfer balance cap to $1.9 million from 1 July. It sort of begs the question whether people will be implementing non-concessional contribution strategies this year or next year with a higher balance. So, I question how many non-concessional strategies will be used, but certainly from a concessional contribution strategy point of view, we're certainly, I think, going to see a lot of people looking to utilise the carry forward concessional contribution strategy, given that we're pretty much at 4 years in or so. So it's maximising the capacity to make or to claim personal tax deductions there. So we'll see a lot of that. And we may also see a little bit of downsizer with the age changes that occurred this year as well. But I do take a bit of interest in where people are going to sit with the non-concessional contributions because of the indexation of the general transfer balance cap.
And those inflationary pressures, I guess, are going to be probably impacting contributions to some extent as well. So where people may have previously been accelerating contributions for whatever purpose, retirement planning or for LRBAs or whatever it is, the fact that we've got inflationary pressures, changing the indexation of the cap, not in 100,000, but in the $200,000 block. But that may also be having a bearing on people's own individual circumstances as well and their capacity to be able to service debt outside of superannuation, which then moves the needle in terms of what they can potentially put inside super as a salary sacrifice or even as a member deductible contribution at the end of the year.
Yeah, absolutely. And look, another thing that I sort of hadn't really thought through too significantly, but yesterday always gives food for thought when there's an increase or another increase in the mortgage rates. And that is, how many people will genuinely be looking to downsize because they're trying to shrink their mortgages as well. And with the reduction in age to 55, it's far more relevant, I think, because, you might look at your post 65-year-olds as not having mortgages, but certainly those in that 55 to 65 category are more likely to still have some level of debt. And so, potentially we'll see a little bit there because of the inflationary pressures and the pressures of those higher interest rates.
Yeah. And I think you've touched on this a little bit already, but what becomes very apparent in tax planning season is there is a real interaction of various contribution strategies. And I mean, you've already spoken about non-concessionals, downsizer, concessionals, unused carry forward. And a lot of these things can actually interplay as part of the tax planning opportunities with your clients.
Absolutely. And I think that's one of the key things. And, I like to talk about things such as that carry forward concessional contribution because it does provide a lot of opportunities, because I think we often get lost in, particularly when talking about self-managed super funds, of we just make this association that self-managed super funds are full of high net wealth individuals. But the reality of the statistics that the ATO provide is that the vast majority of SMSF members have less than $500,000 from a membership point of view. And so it opens them up to that concessional contribution carry forward capacity. And so then again, if we're looking at, are they looking to free up capital by selling down on other investments, for example, and do those investments bring capital gains tax liabilities? And so therefore, is there, one-off opportunities to use something like the carry forward amount, but then also at this time of year, say, okay, well, next year, I maybe won't have as much need for using concessional contributions and I won't be utilising my full cap. So can I potentially even bring forward via the contribution reserve type strategy? Can I bring forward potentially 1 year or half of 1 year's cap to maximise my deduction capabilities this year?
And just in terms of pensions, what are some of the things they might need to be thinking about with that?
Yeah, look, and I think this is where it's really fascinating. And I know Aaron and I have spoken about it. We've blown up the concept of the superannuation life cycle as far as, you set up your fund, you contribute, and then you retire. Now we've got this period of ultimately 15 years from age 60 through to 75, where people will be potentially transitioning to retirement, but won't be in that full retirement. And they've got the capacity without any work test requirements to be able to contribute alongside commencing pensions. So we've got the inevitable question that's going on at the moment of, do you delay your pension commencement until 1 July next year, purely for personal transfer balance cap purposes? And so therefore, if you are looking at a 1 July pension commencement date, and then you're contemplating all these other contribution strategies, from a personal deductible contribution point of view, are you aware of your requirements that you have to provide your notice of intention to claim a tax deduction prior to commencing the pension, which means you've ultimately got, 23 days to get that notice lodged with your superannuation fund prior to being able to put in your application to start a pension. So, the nuance between pension commencements and claiming personal deductible contributions is a fairly critical one. And to take that one step further, all those clients that potentially start pensions on the 1st of June, have they contemplated that prior to the point where right now they're probably thinking about whether they can claim a personal tax deduction, and it may be too late if they've nominated a 1 June start date for their pension commencement as well.
Yeah, and I guess the concept of SMSF tax planning, we think about, the immediate tax benefit that is here. But as you've rightly pointed out, for someone now that has the capacity to undertake contributions, and the planning of contributions through to 75 means that we do have this 15-year window where we could be actually interchanging pensions and contributions. And therefore, tax as a driver then also comes into things like recontribution strategies. And it also comes in, as you rightly pointed out, that whether you defer or not on making that pension commencement 1 July 2023 because of the indexation of 1.9, but there may be some tax issues inside the fund in the current year that you may be better to get the ECPI claim in this year because of, again, asset disposals or other high levels of distributions and so forth. So I guess the tax planning concept, even when we think about pensions, does have very broad application now, because we're not only looking at the immediacy of the deduction here, but we're also looking at the planning that is presented both inside the fund and then more broadly from an estate planning context as well.
Yeah, and look, without sort of getting too technical about some of those elements, one of the things that we have to be mindful of, and it's less relevant this year, but when we're talking tax planning, it's the concepts that come up year in, year out. Yeah. And with the likelihood of with the increase back to the standard minimum pension requirements next year, it means cash flow becomes relevant again. And we need to make sure that we're not operating in a 50% reduced environment. We're operating at 100% pension obligations. And so, often we see, okay, well, we've been operating under 50% for 4 years now. So our dividends or whatever might have been covering our cash flow, but we might actually need to sell down on capital inside the fund to be able to fund pensions. And if we've got a mixture of pension and accumulation, where do we sit from an ECPI point of view? So tax planning is tax planning from the super fund point of view and tax planning from the individual point of view.
And to that, I guess from an investment strategy and restrictions viewpoint, those sort of issues then also are very relevant when we think about our RBAs. I know that we're about to see the published rate for the safe harbour, which will be north of 8.6, probably closing in close to nearly 9%. So, those are all a range of tax considerations that we need to be thinking about. Anything else, I guess, from that point of view as well?
Oh, well, I mean, so not only is there the interest rate consideration from an LRBA point of view, but there's also, I think we're conveniently forgetting, or not conveniently forgetting, but it's easy that now that the World Health Authority or whatever they call themselves have declared that the pandemic's over, it's not over from a tax point of view, because whatever planning we did with regards to our in-house asset rules, with regards to our limited recourse borrowing, rescheduling of the repayments, we still have to factor all of those elements in, and we have to operate in a more SIS-compliant environment now from the investment restriction point of view. And so we need to make sure that we've got our cash flows so that we can not only pay off those limited recourse borrowing related party loans and things like that, but also with regards to our in-house assets, that we are actively operating under whatever written plans we're putting in place to sell down investments. So if we breached the in-house asset rules last year, did we put a promise in place to sell down those assets by 30 June this year? And have we undertaken that plan? What will the ramifications be with regards to those previous investment decisions that we've made?
And just to finish off, are there any other tips or traps that advisors should be aware of with their SMSF clients as we head towards 30 June?
Look, I think probably the biggest trap at the moment is that because we've just passed lodgement date, so most self-managed super funds, or hopefully most self-managed super funds have lodged their returns now. So we're now in that point where we've got the total super balances, or hopefully got the total super balances accurate from a MyGov point of view. And that goes a long way towards the planning capacity to utilise some of these various strategies to make non-concessional contributions, or to use the carry forward concessional contribution set of rules. So, one of the big tips is, if you haven't lodged the super fund returns for last year, get it done, because it ultimately impacts any capacity to do any contribution planning in the current year. It really limits your time and capacity, but also just understand all your notice requirements.
Yeah, and I think, Tim, to that point, you raise a really interesting issue around the TSB definition. And I know this is really relevant in the context of the $3 million discussion and around the additional earnings tax and stuff, but understanding what has been included within the financial statements that actually helps determine the calculation of TSB, because, it could be the difference between being $505,000 and $497,000, which then does potentially influence whether you can make concessional contributions that would have valued to any prior unused carry forward amounts in the last 4 years. So I think if you're a financial advisor, you want to be looking at those SMSF financial statements, whether the administrator, the accountant has done, and understand the nuances of what a total superannuation balance is, to then identify whether that amount maybe should be, like I said, the 497 rather than the 502, because it then opens up all the strategies that were potentially available to the client, because the accounting of that member balance really isn't reflective of what the TSB should be.
Yeah, correct.
Thank you so much for joining us today, Tim, and sharing all those helpful tips for tax planning for the lead up to 30 June.
No worries. Thanks very much for having me.
Excellent. Thanks, Tim.
Cheers.
So, Miranda, there's obviously plenty of opportunities that come around 30 June each and every year. And Tim shared some insights into, I guess, some opportunities across contributions and pensions, and I guess more broadly around the investment rules as well. What are some of the key takeaways that you got from that discussion with him today?
I thought it was quite interesting how he highlighted the fact that sort of the need to plan in terms of interest rates, particularly with some of those loans that may have delayed or deferred some of those repayments during COVID, and now they're having to repay those, and they're also faced with higher interest rates on top of that, which could be quite challenging for some funds.
Yeah, and that inflationary flow-on effect, I guess, because, we're in a period where clients are waiting potentially now to go, well, do I not make this contribution yet or not start this pension yet, because the balance is going to be going up from $1.7 to $1.9 million from a transfer balance cap point of view. So there's a lot of things that interact and play together that we need to get right at this time of year, and not only looking at it from the tax position of the individual, but we need to be contemplating it potentially from the tax position inside the self-managed super fund. And there's things like deemed segregated periods and a whole range of that sort of tax-based issues. And then, of course, we've got the estate planning tax issues that we can look at from recontributions and things as well. So there's always a significant amount of planning work that can be done, not only as we lead up to 30 June, but obviously on an ongoing basis. And that interaction, I guess, that we see and crossover with pensions and contributions now certainly open up an even bigger scope to be targeting these opportunities with your SMSF clients.
Yes, certainly plenty to be thinking about.
Absolutely. So as is always the case, Miranda, if anyone has any topics, suggested speakers, or things they'd just like to hear about on the SMSF Advisor Show, how can they get in contact with us? So
they can get in touch at editor@smsfadvisoronline.com.au.
Excellent. Well, thank you once again for joining us for this edition of the SMSF Advisor Show. I look forward to you joining us for our next edition. Have a great rest of the week. Take care and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you feeling the strain of high mortgage repayments? Refinancing with Finny Mortgages can help you save big on your home loan and ease the burden on your finances. Our team of expert brokers specialises in helping Australian investors find the best possible rates. Refinance with Finny Mortgages today and start saving. Visit finny.com.au or call us now at 028 866 2444 to chat with an expert.